Welcome to the Deep Dive. Today, we're really cracking open the fundamentals of finance and investing.
Yeah, we're drawing from a pretty foundational lecture by Bill Ackman.
And our mission here really is to unpack his core ideas for you. We want to walk through the building blocks, how businesses actually work, what really matters when you're thinking about investing.
Exactly. And we'll start super simple. Think a lemonade stand and build up from there.
Right. Think of this as, your shortcut to getting those key financial concepts, that practical wisdom, straight from the source, but without all the jargon.
Okay, let's dive in. So imagine that simple business, the lemonade stand. You've got the idea. Now what?
You need to make it official, right? And get some cash to start.
Precisely. First step, often, is forming a separate legal thing, like a corporation. Let's call it Bill's Lemonade Stand Inc.
Okay, makes it distinct from you personally?
Right. Then, capital. Money. Where does it come from? Well, two main ways. Sell ownership or borrow.
Selling ownership, that's selling stock, bringing in investors.
Exactly. So in this example, maybe you say, your idea, your initial work, it's worth 1,000 shares. You keep those.
Okay.
Then you find someone, an investor, who puts in $500 cash for another 500 shares.
So they pay $1 per share. And you kept 1,000 shares. So your part is valued at $1,000 based on that price.
You got it. So the business now has an initial equity value of $1,500. That's the $1,000 for your founder shares plus the $500 cash the investor put in.
And that $500 is cash the business can use.
Right, but maybe $500 isn't quite enough to really get things rolling. You could sell more stock, but...
Yeah, that means giving up more ownership, diluting your stake.
Exactly. So the other option is borrowing. Debt.
Like asking a friend for a loan.
Sure, let's say you borrow $250 from a friend, and you agree to pay them, say, 10% interest per year.
Why borrow instead of just selling more stock? Seems simpler, maybe?
Well, it's about leverage. If you think the business is going to do really, really well, earn much more than that 10% interest, then borrowing allows you, the owner and your first investor, to keep a bigger slice of those high future profits.
Ah, okay. So it adds risk to the business, definitely. But the potential reward for the owners goes up if it works out.
That's the fundamental trade-off. Now, how do we see where the business stands financially right after raising this money?
That's the balance sheet, isn't it? Like a financial photo at one moment in time.
Exactly. It lists what the business owns. Those are assets, what it owes liabilities, and what's left for the owners, that's shareholder equity.
So right at the beginning, before spending anything.
Okay, assets would be the cash you just raised, the $500 from stock, plus the $250 loan, so $750 cash. Plus, in this simple model, that $1,000 value we put on your idea, sometimes called goodwill, so total assets, $1,750.
And liabilities, that's the loan, right?
Yep, the $250 you owe your friend. And shareholder equity is that $1,500 initial value we talked about.
And it has to balance.
Always.
Yeah.
Assets, $750 equals liabilities, $250, plus shareholder equity, $1,500. That's the rule. That's your starting point.
Okay, so we have $750 in cash burning a hole in the company pocket. Time to buy stuff.
Time to put it to work. You need the actual stand. Let's say that costs $300. That's a fixed asset. It lasts a while, but it does wear out.
Depreciation. We'll get to that.
Right. And you need supplies. Sugar, lemons, cups, all that stuff. Inventory.
Inventory, okay.
Let's say you spend $200 on enough supplies to make, 800 cups of lemonade. So you've spent $500 total.
So cash goes down.
Cash goes down, absolutely. You started with $750 available, spent $500, $300 stand, plus $200 inventory. So you have $250 cash left.
But you gained other assets.
Exactly. You swapped cash for a $300 fixed asset, the stand, and $200 in inventory. Your goodwill is still $1,000. Add it up. $250 cash plus $300 fixed asset plus $200 inventory plus $1,000 goodwill. Still $1,700 good assets.
And the other side, liabilities and equity.
Unchanged just from buying assets. Still $250 loan liability and $1,500 equity. See, it still balances. You've just changed the form of your asset.
Okay, stand is built, supplies are bought. Now we sell lemonade. How do we know if we're actually, making money or losing it?
That's the income statement. It tells the story over a period like your first year. It tracks your sales, your costs, and gets you to the bottom line, profit or loss.
So let's walk through year one for Bill's Lemonade Stand. Assumptions.
Okay, simple assumptions. You sell all 800 cups you bought supplies for. You charge $1 per cup. So, revenue.
800 cups times $1. $800. Easy enough.
Right. Now, costs. What did it cost to make those specific 800 cups? That $200 you spent on supplies, that's your cost of goods sold, or COGS.
Got it. $800 revenue minus $200 COGS. What else?
That stand. It doesn't last forever, remember? If it lasts 5 years, that $300 cost gets spread out. So $300 divided by 5 years. That's $60 per year in depreciation expense.
Okay, so depreciation counts as a cost even though you're not spending cash that year on it.
Exactly. It reflects the using up of the asset. And you probably need someone to actually run the stand, right? Labor costs, let's say that's $530 for the year.
Right, so $800 revenue minus $200 COGS minus $60 depreciation minus $530 labor.
That leaves you with $10, just $10. That's called earnings before interest and taxes, or EBIT. It's your operating profit.
$10 profit on $800 revenue. That's the margin.
Yeah, it's really thin. $10 divided by $800 is about 1.3%. Very low profit margin from operations.
And we haven't even paid the interest on the loan yet.
Good point. Remember that $250 loan at 10%? That's $25 in interest expense for the year.
So take the $10 EBIT, subtract the $25 interest.
And you get Vitabus $15, a $15 loss before taxes. Since you lost money, we'll assume no taxes are due in this simple case.
So the final net income, the bottom line for year one, is negative $15, a loss.
Yeah. Not exactly a roaring success based on the first year's income statement. Low margin, loss after interest.
And that loss, it doesn't show the whole cash story, does it? Like, where did the cash actually go?
No, the income statement doesn't track cash directly. For that, you'd look at the cash flow statement. It reconciles the net income with the actual change in cash. You started with $750 available, remember?
Right, from stock sale and the loan.
And the balance sheet at the end of year one shows cash is down to $500. So cash decreased by $250. Why? Well, you had the $15 net loss, plus you spent cash on the stand, $300, and inventory, $200 initially, which are investments, not immediate expenses on the income statement. The cash flow statement ties all that movement together.
Okay, so let's look at that end of year balance sheet again. What changed after year one?
Well, cash is down to $500, as we said. The fixed asset, the stand, is worth less because of depreciation. $300 minus that $60 depreciation expense leaves $240.
Their inventory.
Inventory gets used and replenished, so it fluctuates. The source example keeps it simple and focuses on the main changes. Goodwill is still $1,000. The loan liability is still $250.
And the owner's part, shareholder equity, that must have changed because of the loss.
It did. Started at $1,500, the source shows it decreasing to $1,490. It looks like they deducted the $10 EBIT loss in this specific simplified model rather than the $15 net loss after interest. The key point, though, is that losses reduce shareholder equity. The owner's claim on the business value shrinks.
So, end of year one, less cash, less equity, a net loss. Honestly, sounds like maybe you should just stop. Cut your losses.
And many would. It looks pretty bleak. But here's where the investing mindset kicks in. What if you don't stop? What if you assume the core idea is okay and you just need scale?
What do you mean?
What if you reinvest every penny the business generates back into it? No dividends for the owners yet. Use that cash to buy more stands. Maybe you can raise prices just a little each year, like 5 cents a cup. And maybe each stand can sell 5% more cups each year as you get better known. You make some growth assumptions.
Okay, projecting out, what happens by, say, year 5?
Oh, the picture changes completely. You might go from 1 stand to 7 stands. Price per cup is higher. Revenue isn't just 7 times higher. It's gone from $800 to nearly $8,000.
Wow, what about costs? They must go up too.
They do, but hopefully not as fast as revenue. You get operating leverage. And that tiny 1.3% profit margin we saw in year 1.
Yeah.
By year 5, in this projection, it balloons to over 28%.
28%, that's huge.
It shows the power of scaling a potentially sound business model. Your earnings before taxes, after paying that $25 interest each year, jump to around $2,300.
And after taxes, assume rates say 35%.
After 35% tax, your net income, your actual profit, is about $1,500 by year 5.
$1,500 profit. Remember that investor paid $1 per share initially. Now the business is earning $1 per share. $1,500 profit, 1,500 total shares.
Suddenly, that $1 initial investment looks pretty darn good, doesn't it?
Yeah, it does. So how do we step back now and say, okay, is this a good business objectively?
You look at the returns. What return are you getting on the money invested? The initial equity valuation was $1,500. By year 5, it's generating $1,500 in profit annually. That's like a 100% return on that initial valuation.
Yeah.
Or look at the actual cash spent on the stands themselves. Maybe you spent $2,100 total building those 7 stands by year 5. Well, the business earned $2,336 in operating profit, EBIT, in year 5. That's also over 100% return on the physical capital invested.
A business earning over 100% return on the capital it employs.
Yeah, that's attractive. Very attractive. Plus, look at the growth. Earnings grew incredibly fast, 155% per year in the projection. And profitability went from almost nothing to nearly 30%. Those are signs of a potentially excellent business.
And this whole journey really highlights the difference between lending money and buying ownership, doesn't it?
Oh, absolutely. Let's compare your friend the lender and your initial equity investor.
The lender put in $250.
Right, and they get 10% interest, $25 a year. That's it. Their position is safer, relatively speaking. If the business goes bust, lenders get paid back first from selling off assets, like the stands. They have a senior claim.
But their upside is capped at that $25 a year.
Exactly. Now, the equity investor, they put in $500 for 500 shares. They saw a loss in year 1 on paper. But by year 5, the business is earning $1 per share. Their initial $1 investment is now generating $1 in annual profit.
Their potential return is way, way higher.
Potentially much higher. Why? Because they took way more risk. Equity holders have a residual claim. They get whatever's left over after everyone else, especially lenders, gets paid. If the business fails, they could easily get nothing.
So higher risk, higher potential reward. Debt is safer, limited return. Equity is riskier, unlimited potential upside. That seems to be the core principle.
It's fundamental, and it applies across all sorts of debt and equity mortgages, bonds, preferred stock, common stock. Debt generally comes first, equity gets what's left.
When you talk about that risk, what's the risk we should really care about as investors? Is it the price bouncing around day to day?
Well, according to Ackman's perspective here, and many value investors agree, the day-to-day volatility isn't the main thing. The real risk is the possibility of a permanent loss of your capital. You invest $1,000 and it actually goes to zero or close to it and never comes back. That's the risk that kills long-term wealth building.
How do we judge risk then? What's the benchmark?
You usually compare it to the safest available investments, like U.S. government bonds. If a 10-year Treasury bond pays, say, 3% interest, that's considered very low risk.
So that 3% is like a floor.
Kind of, yeah. If you're going to lend money to a brand new lemonade stand, which is obviously way riskier than lending to the U.S. government, you need a much higher return than 3%. That's why the friend demanded 10%.
And the equity investor needs even more potential return.
Because they're taking even more risk than the lender. They're last in line. So yes, the potential reward for equity has to be significantly higher to compensate for that risk.
Okay, let's switch gears slightly. Think about the owner of this successful, growing lemonade empire now. What if they personally need cash, say $4,000 for a car, but all the business cash is tied up in growth?
Ah, the successful entrepreneur's dilemma. Their net worth is high, but it's all illiquid, tied up in the private business. What can they do?
Well, they could just start taking money out, right? Pay themselves a dividend.
They could. Pro, they get cash. Con, that's cash not being reinvested, so the business's growth slows way down. Plus, maybe the business only has, say, $2,000 in cash available by year 5, not enough for the $4,000 car anyway.
Okay, what else? Sell the whole company.
That's an option. Big payout, potentially. But then you lose out on all the future potential you worked so hard to build.
So maybe sell just a piece.
Exactly. You could try to find another private investor to buy some shares. Yeah. Or, if the business is big enough, established enough, you could take it public, an IPO.
Initial public offering. We hear that term all the time. What's really involved?
It means selling shares of the company to the general public for the very first time. Listing it on a stock exchange like the NYSE or NASDAQ. It's a pretty complex and expensive process. You need investment bankers to help price and sell the shares, lawyers to write this huge document called a prospectus detailing everything, risks, financials, history.
It's like a lot of hassle. Why do it?
Main reasons are access to capital and creating liquidity. The company itself can raise money by selling new shares to fund more growth. And importantly, for our owner needing cash, they can sell some of their existing shares to the public in the IPO. They get their $4,000 without selling the whole company.
But there have to be downsides to being public.
Oh, definitely. You have to disclose tons of information publicly every quarter. You have a board of directors representing all shareholders, not just you. Less flexibility, lots more regulatory burden. It's a different world than being private.
But the big plus is liquidity.
Huge plus. Once the stock is trading on an exchange, the owner, the initial investor, anyone who owns shares can generally buy or sell them much more easily. It makes the ownership stake liquid.
Before you can sell shares, though, you need to know what they're worth.
Yeah.
How do you value a business like this lemonade stand?
Right, valuation. It's part art, part science. A common way is comparable company analysis, or comps. You look at similar public companies, maybe other beverage or fast food businesses in this case, and see how the market values them.
How do you measure their value? Market cap.
Yeah, market capitalization. That's just the company's stock price multiplied by the total number of shares outstanding. It tells you the market value of the company's equity.
And then you use ratios, like the price-to-earnings ratio, PE.
Exactly. You see what multiple of earnings those comparable companies trade at. Let's say similar. Growing businesses trade at 20 times their annual earnings, a PE of 20.
Okay.
Our lemonade stand, we projected, earns $1 per share in year 5. If a 20x multiple is appropriate, then its shares might be worth $20 each. $1 earnings, 20 PE.
And there are 1,500 shares total.
So 1,500 shares times $20 per share. That suggests a total equity value of $30,000.
Wow. From an initial value of $1,500 to potentially $30,000 in 5 years.
Yeah.
That really shows the value creation.
It does. And if the owner needs that $4,000 and the shares are valued at $20, they could sell 200 of their shares, $4,020 per share in the IPO. They get their cash, their ownership percentage drops a bit, but they still own most of the company.
Are there other ways to value a business?
Oh, yeah. More sophisticated ways involve projecting out all the future cash flows the business is expected to generate and discounting them back to their present value. That's discounted cash flow, or DCF analysis. A bit more complex.
The source also mentioned comparing earnings yield to bond yields.
Yes, this is a really useful concept. Earnings yield is just the inverse of the PE ratio, so earnings per share divided by price per share. A 10x PE means a 10% earnings yield. 110.
Okay, why is that useful?
You compare it to safer investments like that 10-year treasury bond yielding maybe 3%.
Yep.
You can think of the earnings yield as the potential return or coupon the business is generating for you at the current price.
But unlike a bond coupon, the earnings aren't fixed, right?
Exactly. That's the key difference. With a good business, you hope that coupon the earnings will grow over time. A bond coupon stays the same. So you might look for businesses where the current earnings yield is already higher than bond yields, and you expect those earnings to grow significantly. Paying a really high PE means a low starting earnings yield, so you're really banking on future growth.
Understanding valuation is so key, whether you're running a business or investing in one. Okay, let's bring this home. How do these core ideas, compounding, risk, understanding businesses, apply to us as individuals trying to build our own financial future?
Right. This is where it gets really practical for everyone listening. And maybe the single most powerful factor, especially for younger listeners, is time.
Compounding.
The magic of compounding. It's almost hard to believe. Let's run those numbers again. Invest $10,000 at age 22. Earn 10% a year. By age 65, that's over $600,000.
Okay.
But wait just 10 years. Start at age 32 with the same $10,000 and the same 10% return. You end up with only $232,000.
Less than half, just from starting 10 years later.
That first decade of compounding is that powerful, and if you can earn higher returns, say 15% over those 43 years, that $10 becomes over $4 million. 20%. It's over $25 million. The returns magnify the effect enormously.
The famous Einstein quote about compound interest being the most powerful force.
Seems about right. So start early, aim for good returns, and the crucial third piece.
Don't lose money. Buffett's rules.
Rule #1, never lose money. Rule #2, never forget rule #1. Why? Because big losses absolutely crush your compounding journey. If you have $1 million and lose 50%, you're down to $500K. You now need a 100% return just to get back to where you started. It sets you back years, maybe decades.
So avoiding big losses is paramount. Where should an individual investor focus their efforts? Trying to find the next tiny lemonade stand startup.
Probably not for most people, according to this perspective. The risk in very early stage companies is just too high. The source suggests focusing on publicly traded securities, stocks of more established companies listed on exchanges.
Why public companies?
Generally, they're more established, there's more information available, and importantly, the shares are liquid. You can usually buy or sell them relatively easily. You don't need to hit grand slams. Consistent, solid returns over decades build massive wealth through compounding.
What kind of public companies should you look for then?
First rule, invest in businesses you can actually actually understand. How do they make money? If it seems like a black box, like Enron famously was, stay away. Complexity often hides problems.
And price matters too, right?
Absolutely. Even the best company in the world can be a terrible investment if you pay way too much for it. Valuation is key.
What about that idea of buying businesses you could own forever?
Yeah, that's a great mental filter. Ask yourself, if the stock market closed for 10 years, would I be comfortable owning this business? It pushes you towards durable, high-quality companies.
Well, it makes a business durable like that.
Things like selling a unique product or service that people need or really want, maybe with strong brand loyalty. Think Coca-Cola, where people pay a premium for the brand, not just any cola. Or See's Candy, another classic example of brand power.
Barriers to entry, too, making it hard for competitors.
Definitely. High barriers to entry protect profits. Think about Coke's global distribution and brand recognition, incredibly hard for a new soda to compete with that scale.
And low debt.
Crucial. Businesses with very little debt are much safer. They won't go bankrupt just because of a temporary downturn or rising interest rates. Look for companies earning many times their interest payments.
What about immunity to external factors?
Right. Ideally, the business isn't super sensitive to things outside its control, like fluctuating commodity prices if they can pass costs through, or big swings in interest rates or currency exchange rates. Think about businesses that have thrived through wars, depressions, pandemics. They often have this resilience.
And capital intensity. You mentioned that earlier.
Yeah, this is huge. The best businesses often don't need to constantly pour tons of money back into factories and equipment just to stay competitive or grow modestly. They're capital light. They generate lots of free cash flow.
Like software or brands, or maybe royalty businesses.
Exactly. Contrast that with, say, airlines or auto manufacturers, which are incredibly capital intensive. Businesses that earn royalties on other people's capital, like Visa or MasterCard, getting a tiny slice of every transaction, are often fantastic models. Low capital needs, high returns.
One last point there was about control.
Yeah, be a bit cautious if there's one dominant controlling shareholder, unless that person has an absolutely stellar reputation for treating all shareholders fairly. You don't want your interests as a minority owner to be ignored.
Okay, that's a great checklist for what kind of business to look for. But practically, when should someone start investing in the stock market? Are there prerequisites?
Yes, absolutely crucial prerequisites. Priority number one before investing a dime in stocks: pay off high-interest debt, especially credit cards.
Why is that so important?
Because paying off debt that charges you, say, 18% interest is like earning a guaranteed risk-free 18% return on your money. You're extremely unlikely to consistently make that kind of return safely in the stock market. Get rid of that high-interest debt first.
Makes sense. What's priority two?
Build an emergency fund. You need cash set aside for unexpected life events, job loss, medical bills, car repairs. How much? Generally, 6 to 12 months worth of essential living expenses kept in a safe, easily accessible place like a savings account.
So only after the bad debt is gone and the emergency fund is full.
Then you start investing money that you are reasonably sure you won't need for at least 5, ideally 10 or more years. Why the long time frame? Because the market goes up and down, and you need to be able to ride out the downturns without being forced to sell at a loss because you suddenly need the cash.
Which brings us to psychology. It sounds like the mental game is just as important as the analysis.
Well, it might be more important for many people. The math isn't that complicated, but controlling your emotions, that's tough. The biggest enemy is often ourselves, our fear and greed.
The herd mentality. Buying high, selling low.
Exactly. It feels safe to do what everyone else is doing. Buy when stocks are soaring and everyone's euphoric, sell when things crash and everyone's panicking. But that's usually the exact opposite of what you should do for long-term success.
The market being a voting machine, short-term, weighing machine, long-term.
That's the classic Ben Graham analogy. Short-term, prices are driven by popularity contests, news headlines, emotion voting. Long-term, prices tend to reflect the underlying value and earning power of the business weighing. You have to believe in the weighing machine over the long run.
Which means you need the stomach to handle seeing your investments go down sometimes.
Absolutely. Volatility is the price of admission for potentially higher long-term returns in stocks. If you own good businesses bought at reasonable prices, a market dip isn't necessarily a disaster. It might even be an opportunity. But you need the fortitude to see it through.
How do you build that fortitude?
Well, first, being financially secure helps immensely, having that emergency fund, no bad debt, not investing money you need soon. Second, understanding that short-term market noise is noise. Third, and maybe most important, do your homework. Really understand the businesses you own. That knowledge builds conviction. When you know why you own something, you're less likely to panic sell just because the price drops.
Okay, but what if someone listens to all this and thinks, wow, that's a lot of work. I don't have the time or maybe the interest to research individual companies like that. Are there alternatives?
Yes, definitely. You can outsource it. The most common way is through mutual funds.
How do those work again?
You basically pool your money with thousands of other investors, and a professional fund manager invests that pool according to a specific strategy, maybe large U.S. companies or international stocks or bonds.
What's the benefit?
You get instant diversification, even with a small amount of money, and you get professional management. The challenge, though, is there are thousands and thousands of mutual funds. You still need to do some research to pick a good manager or fund.
What should you look for in a fund manager?
Similar principles apply. Can they explain their strategy simply? Do they have a reputation for integrity? Ideally, they follow a value-oriented approach, buying good businesses at sensible prices. Look for a long track record, at least 5, preferably 10, 20 years, to see how they performed in different markets.
Consistency, too. Sticking to their strategy.
Very important. You don't want someone chasing fads. And alignment of interest is huge. Does the manager have a lot of their own money invested right alongside yours in the same fund? That's a good sign. Also, generally avoid funds that use a lot of leverage or debt.
And even if you use funds, diversification still matters.
Yes. Don't put all your eggs in one basket, even with managers. Maybe owning 2 to 4 different funds with somewhat different but sensible strategies makes sense. Or if you are picking individual stocks after doing intense homework, owning maybe 10, 20 well-understood, high-quality companies might be enough diversification for some. The point is to spread your risk.
Wow. We've covered a ton, starting from that basic lemonade stand and building up through financial statements, debt versus equity, growth, risk, valuation, all the way to practical investing principles.
It really is a journey through the foundational concepts. And what's neat is that these ideas, understanding value, weighing risk and reward, the incredible power of compounding, knowing the difference between owning and lending, they're not just for Wall Street.
Right, they apply everywhere. Buying a house, deciding whether to invest in your own small business, even career decisions have elements of this.
Absolutely. Understanding these financial principles truly matters for your quality of life, your ability to achieve your goals, how comfortably you can retire. It's worth spending time on. Learning this stuff is genuinely an investment in yourself.
So maybe the provocative thought for you listening is this. These concepts, starting with something as simple as a lemonade stand, are the fundamental building blocks of wealth creation and financial security. They're operating all around you. Learning to see them, understand them, and apply them in your own life might be one of the most impactful things you can do for your future.
Well said. It really boils down to starting early if you can, understanding what you own, being patient through the ups and downs, controlling those emotions, aiming for good returns, and above all, avoiding those catastrophic losses. It's simple, but not easy, but incredibly powerful if you stick with it.
Thank you for joining us for this deep dive.
Thank you for listening to the Investing Podcast.